Hi, welcome back to Lee Capital Trading. This is Eddie Lee, and this is video 8 of our 12-part free course series on technical analysis. Up to now, we built the technical side, so we learned about candlesticks, trading levels, trends, indicators, and trading plans. But now we get to the part that decides whether you actually keep your account. Because most traders don't fail because they can't recharge. They fail because they can't manage themselves. See, fear makes them exit too early. Greed makes them size too big. Revenge makes them jump into bad trades. And hope makes them hold numbers too long. Poor risk management turns small mistakes into account damage. So this video is about the mental side of trading and the rules that protect you when emotions show up, because they will eventually do show up. So please take a minute right now to like and subscribe, and so we can get started.
Here is the hard truth. A good strategy alone is not enough. You can know support and resistance. You can know MACD. You can know moving averages. And still lose money consistently. Why? Because trading performance is shaped by how you behave under uncertainty, loss, pressure, and temptation. Not just by chart knowledge. Bad psychology destroys good setups. And bad risk management makes your psychology worse. When you're oversized, every candle feels emotional. Every pullback feels terrifying. Every red tick feels personal. So the goal is not just to find better entries. The goal is to become stable enough to execute correctly, every session, regardless of whether the last trade won or lost. There are 4 emotions that destroy traders over and over again. Fear, greed, revenge, hope. Fear makes you hesitate, exit early, skip good setups, or size down from panic. Greed makes you oversize, chase candles that have already moved, ignore your targets because you want more, and overtrade on good days until you've given everything back. Revenge is what happens after a loss, when you need it back immediately. A revenge trade is not taken because the setup is good. It's taken because your ego got hit, and you want your money back right now. That is emotion wearing a chart costume. Hope is when you know the trade is wrong but you refuse to close it. You move the stop. You tell yourself it will come back. You negotiate with the market. The market doesn't negotiate. All 4 have one thing in common. The moment they take over, you stop following your plan. And a plan you don't follow is not a plan. Let's start with fear, the most common emotion in trading. Fear doesn't always look dramatic. Sometimes it looks responsible. It looks like exiting early to, quote, protect profits. It looks like skipping a setup that's, quote, a little risky. It looks like hesitation. But fear changes your execution. You stop following the rules, not dramatically, but quietly. You can see the damage clearly in this chart. The trade hit the fear exit early. Then price continued exactly to the target, without the trader in the position. The setup worked. The fear didn't. Here's the critical insight. Fear gets significantly worse when your risk is too big. When you're oversized, your brain activates stress responses. Rational thinking gets impaired. Every tick feels personal. One of the most effective ways to reduce fear is not a mindset trick. It's smaller position size and clearly defined risk. When you know the absolute worst case before you enter, the brain calms down and executes correctly. Now let's talk about greed, and why winning can actually be dangerous. Greed usually shows up after success. You win a few trades. You feel sharp. You feel invincible. You start thinking you've cracked the market. And then greed whispers, "You're seeing it perfectly today. Size up. Take one more. Push harder. Ignore the target. It's going higher." And then one loss takes back everything. Sometimes more than everything. Greed lowers your standards. You start taking setups that only half qualify. You stay in trades past your target. You trade when you should have stopped for the day. The professional response is simple but hard. The rules don't change based on how good you feel. Risk stays fixed. Targets get respected. Checklists still get run. Discipline means your behavior is consistent on your best days and your worst days. That consistency is the edge. Revenge trading is one of the most destructive habits in all of trading. Here's how it works. You take a planned loss. That part is fine. But then the ego gets hit. The immediate instinct is, I need that back now. So you jump into the next trade without waiting for a real setup. Maybe you size up a little. Maybe you skip the checklist. It feels urgent. That trade loses too. Now you're down more, angrier, and less rational. The spiral begins. Each subsequent trade is taken from a worse emotional state and with worse decision making. This is why your trading plan must explicitly include a stop trading rule after losses. Not after every loss, but after 2 or 3 consecutive losses, or after hitting your daily max loss, you're done for the day. The goal after a bad session is not to recover. The goal is to protect what's left, so you can trade again tomorrow. Staying in the game is the professional priority. Hope is the most dangerous emotion in trading, and the hardest to spot, because it doesn't feel like an emotion. It feels like patience. Hope is what makes traders turn a controlled $100 loss into a $500 loss, into a $1,200 loss. Here's how it happens. You enter a trade. It goes against you. Your stop level is hit. But instead of closing, you tell yourself it will come back. You give it more room. You move the stop lower. Price keeps dropping. You tell yourself the market is wrong. You hold. Price drops more. Finally, you're forced out at a level that is catastrophically far from where the trade went wrong. Look at the chart. The original stop was the plan. Everything below it was negotiation. Expensive negotiation. A professional takes the stop when it's hit. No negotiation. No second chances. The stop was placed at invalidation before the trade was entered. That was your clearest thinking about the trade. Trust that judgment, not the emotional reasoning you do while you're in a losing position. This is where psychology and risk management directly connect, and most traders miss this completely. The reason many traders feel so emotional is not just mindset, it's because their risk is too big. When you're oversized, every tick feels personal. Every candle creates anxiety. Your brain shifts into a survival stress response, and rational thinking gets impaired. You start making decisions from fear, rather than analysis. Look at the 2 equity curves. The oversized trader experiences wild swings, panic, relief, terror, FOMO. The execution is erratic. The emotional labels show exactly what's happening in real time. The fixed risk trader follows a smooth, rising line. Calm, focused, executing. The same setups, completely different psychological experience. When you know exactly how much you can lose on this trade before you enter, your brain calms down. The worst case is defined and accepted. Now you can focus on executing the plan, instead of managing panic. Smaller defined risk creates clearer thinking. Clearer thinking creates better execution. Better execution creates better results. It's a virtuous cycle, and it starts with fixing the risk. One of the best rules you can adopt is fixed risk per trade. That means every single trade, regardless of how much you like the setup, risks the same dollar amount. If your stop is tight, your size can be larger. If your stop is wide, your size must be smaller. But the dollar risk stays constant. This removes emotional sizing completely. You can't tell yourself, this setup looks amazing so I'll risk twice as much. The rule is the rule. Look at the 3 scenarios. Same $100 risk in every case. Tight stop, 200 shares. Medium stop, 100 shares. Wide stop, 50 shares. The math decides the size. Not your confidence, not your enthusiasm, not yesterday's results. This is what keeps one bad trade from becoming a disaster. It's also what keeps you from the opposite problem, undersizing on great setups because you're scared. Fixed risk treats every qualified trade equally. A daily max loss is one of the most important rules in your entire system, because the market is not just testing your strategy, it's testing your psychology. And on bad days, your psychology will try to override your strategy. The daily max loss is your circuit breaker. When you hit it, you stop. Not one more trade to try to recover. Done. Close the platform. Here's why this matters. When you're down on the day, your emotional state is compromised. The brain wants to recover. It takes shortcuts. It ignores checklists. It sizes up. Every additional trade taken from that state has a higher probability of making things worse. Professional frameworks are clear. A mandatory pause after hitting loss limits prevents the emotional spiral that turns a bad morning into a blown account. The goal is not to get the money back today. The goal is to protect what's left and come back tomorrow with a clear head. Tomorrow is a fresh session. You're still in the game. That's the win. Overtrading is one of the easiest ways to destroy a profitable session or a profitable week. Just because the market is open doesn't mean you need to be in it. Just because there's a candle forming doesn't mean it's a setup. Overtrading takes several forms. Trading from boredom, taking every candle that looks vaguely interesting, forcing setups that don't really qualify, staying in front of the screen, and entering trades long after your actual edge has expired for the day. Professional traders are selective. They wait. They let setups come to them. They have no problem sitting in front of a flat, choppy chart for an hour and doing nothing, because they know that doing nothing is the right trade when the conditions aren't right. A gambler needs action. A trader needs edge. Those are completely different things. One good, fully confirmed setup is worth more than 5 marginal trades. Every time, not just sometimes. Every time. Build a maximum trades per day rule into your plan. It forces selectivity and prevents the trap of letting activity feel productive. Let me tell you something that most trading education skips. Big account damage almost always starts with small rule breaks. Not dramatic mistakes. Small ones. You move the stop a little. You enter slightly before the candle closes. You add a tiny bit to a losing position. You ignore one item on the checklist because the trade looks so good. You take one extra trade after your daily limit. None of these feels catastrophic in the moment. Each one feels justified. But here's the real danger. It's not the single mistake that destroys you. It's what those small breaks do to your rulebook. Every time you break a rule and survive, or even profit, you train yourself that rules are optional. That judgment calls are acceptable. That close enough is good enough. And once rules become optional, consistency disappears. And consistency is the entire edge. The professional commitment. Every rule is treated as non-negotiable. Not most rules, not the important ones. Every single one. The moment you start ranking rules by importance, you've already started rationalizing. Most traders think discipline is something you either have or don't have. Like a personality trait. Either you're disciplined or you're not. That's completely wrong. Discipline is built through structure. You don't become disciplined by trying harder to be disciplined. You become disciplined by making bad behavior structurally harder, and good behavior structurally automatic. Here's what builds it in practice. A written plan that's visible during trading sessions, because rules in your head are easier to rationalize. A pre-trade checklist that runs before every entry, because it makes skipping conditions mechanically harder. Fixed risk that removes sizing decisions from your emotions. A daily max loss rule that was decided when your thinking was clear, and now gets honored even when thinking isn't. A journal that shows the truth about your execution. And structured breaks after emotional moments. Notice that none of these are mindset tips. They're all systems, because systems work more reliably than willpower. Structure creates discipline. Discipline creates consistency. That's the sequence. This distinction matters enormously. Real confidence comes from process. It sounds like, I trust my system. I followed my checklist. I've defined my risk. I'll execute the plan and accept whatever outcome comes. Overconfidence comes from outcome. It sounds like, I've won 3 in a row. I'm reading the market perfectly today. Rules are for normal days. Today I can trust my gut. That second voice is expensive. Very expensive. Overconfidence is what makes a great week turn into a flat week, or a negative week. You're winning, so you size up. You're winning, so you skip the checklist. You're winning, so you take one more trade after your daily goal was already hit. And the market, which doesn't care about your recent streak, delivers a reversal. The professional rule, your behavior is the same on winning days and losing days. The strategy doesn't change. The risk doesn't change. The checklist doesn't change. You respect the market on your best days, not just your worst ones. That consistency is what separates sustained performance from lucky streaks. The professional mindset is not emotional perfection. It's not about never feeling fear or greed. Those emotions will always show up. It's about probabilistic thinking, understanding that you're playing a numbers game over many trades, not a guessing game on each individual one. Pillar 1. Think in probabilities. One trade means nothing. The edge plays out over 50, 100, 200 trades. A single loss is just the cost of one sample from your strategy's distribution. Pillar 2. Protect capital first. Capital is the tool. Without it, there are no more trades. Every risk decision starts with, how do I keep this account alive for the next opportunity? Pillar 3. Accept losses as part of the business. Even the best traders lose 40 to 50% of their trades. Losses are not failures. They're part of the strategy's output. A controlled loss following the plan is a professional result. Pillar 4. Measure success by process. Did you follow the checklist? Did you respect the stop? Did you size correctly? If yes, it was a good trade. The P&L just reports the score. Process grades you. I want to give you a simple, daily psychology checklist. Because trading psychology starts before the first click, not during the trade. Here's what to run through every session before you place a single order. Am I calm right now? Not anxious, not overly excited, not frustrated from yesterday. Am I trying to force a trade? If I'm scanning for setups that aren't there, that's a sign. Step back. Did I sleep well? Fatigue measurably impairs judgment and decision-making. It's a real variable. Am I upset from a prior trade? Emotional carryover from yesterday or from this morning's session contaminates new trades. Am I following my plan today? Not just a plan in general, today's specific conditions and context. Have I defined my risk? Dollar amount per trade, set before any order touches the market. If this loses, will I stay stable? If the honest answer is no, reduce size or skip the trade entirely. If any answer points to a compromised state, reduce your size, skip the session, or walk away. Emotional readiness is as much a condition as a candlestick pattern at a key level. That's video 8. Let's take stock of where you are. You've built the technical foundation: candlesticks, support and resistance, trend analysis, indicators. You've built the structural framework: a 5-part trading plan, pre-trade checklist, no trade rules, daily loss limits. And now you've built the psychological armor: understanding the 4 emotions that derail traders, how risk management calms the mind, how discipline is built through structure, and how to think like a professional. This is a complete system, not just a strategy, a complete approach to trading. Next video, video 9, we put everything together: live charts, real setups, every tool from this course applied in real time: context identification, setup qualification, entry trigger, stop placement, position sizing, target selection, and trade management. The full workflow, start to finish. Before you go, hit like if this video changed how you think about trading psychology. Subscribe for video 9, and comment below, which of the 4 emotions hurts traders the most: fear, greed, revenge, or hope? I want to see where the community feels the battle most. And remember, protect capital first. Stay disciplined. The market always gives you another chance, but only if you're still in the game. Disclaimer: everything is for educational purposes only. I am not a financial advisor. All trading involves risk,